Let me guess, you signed up for every free lead magnet and binged on every marketing YouTube video and thought, what am I missing? Why isn't my business exploding like that? Well, I can tell you, you're not alone. Whether you're just getting started or have an established business, entrepreneurship can be really lonely. But it doesn't have to be. Overcoming your fear of launching or building your personal brand or figuring out how to scale, it shouldn't be holding you back. It should be empowering you. On this podcast, we're going to deep dive into the mechanics of what it takes to build your brand, make your mark, and stake your claim in the digital marketing space. I'll be chatting with people from all walks of life and stages in their careers. I will be getting inspiration from real experts who will share their actual strategies and techniques to grow loyal and raving followings and sell more stuff. This is entrepreneurship from people who are already there making it happen. My name is Jeff Mendelson. Join me and welcome to the One Big Tip podcast. Hello, everyone. Welcome back. My name is Jeff Mendelson, and this is the One Big Tip podcast. And today I'm really excited to have Greg Shepard with me. He's the managing partner at Boss Capital Partners. And I just don't want to steal his thunder because he has so much thunder to give. Greg, welcome to the show.
Oh, thank you. I appreciate it. And thanks for that nice comment.
So, Greg, thank you for that. You have a pretty storied background. You have been in the technology scene for a good long time. You worked for, you sold your company to eBay back in the day. Can you please take a few minutes and just talk about who you are and where you are today?
Yeah, sure. I mean, so I started, I started when I was young, pretty poor actually. We didn't have any money. It was a big family and not a lot of money to go around. And so I always had this desire to build businesses. So I started my first real business, I guess I was about 19. And I started a bungee jumping company during that craze and lost all my money. At the same time, I was working for a bank. And then following that, I started a bank and then a biotech company. And then when software really started to come out, when the internet started to hit, I went into software and I've been doing that ever since. So it's been about 20 years in the tech space of building companies. I've built and sold 12 companies, not including those that I invested in as an investor. 2 of those were acquired during that transaction. So eBay had all these assets. It was 14 companies. And we were all tasked to take these 14 companies, carve them out of eBay, take 12 of them and separate them out into individual pieces. And then all of those individual pieces were sold off to separate companies. And then the remaining companies were pulled together. And another one of my companies, so it was actually 2 companies. One was eBay officially. The other one was the new entity after the carve out, after we bought these companies from the public company. And it won 4 private equity awards, tech deal of the year, private equity deal of the year. These were for transactions between 250 and $1 billion. Then I worked on that business. I became the CSO, the Chief Strategy Officer, to sort of figure out the vision of the new business. That was a coalition of all of these different businesses together, 2 of mine and 2 of the ones that we bought, and then another one. And then after I roadmapped that all out, then it required us to rebuild a lot of the technology stack and how everything operated inside the business, everything that had to do with technology. And so I was converted into the CTO, and then I did that for another 2.5 years.
That is a very storied background. Now, this is really interesting because this segues into your one big tip, which is develop a Northstar, right? So when you're thinking about that, you mentioned the roadmap, right? You didn't just randomly come up with one company after another. This was a progression where this was a vision that you had developed that would ultimately you'd be either be able to cash out or to sell to another larger technology company. How do you develop that? Like, how do you envision what your North Star is going to be and then follow through with that?
So, I mean, when you start out, I'll actually start out with this. So, BOSS, which stands for the Business Operating Support System. That's what the book is about, and all of that. Um, what I did is I wanted to find out why businesses were failing. What I learned is that I have to have why businesses are failing, but mostly when they're failing. At what stage are they failing, and then why are they failing at that stage? And then after I went through this whole cycle, this has been going on for, a couple of decades. I started to learn that the thing that hurts these businesses along their entire path, the one thing that is sort of like the big problem. So this is the one big thing, is that they don't have a North Star. So what is a North Star? A North Star is beginning with the end in mind, meaning if you're starting a business, you have to start that understanding what success looks like, what the outcome is that you want at the end. So when you start out with the North Star, and the idea of a North Star is that you have some guidance. So it's like, let's say that I wanted to go from my house to your house and I didn't have your address. I could drive around forever and never get there. But if I had your address, then I could create a roadmap, a GPS that would tell me where to turn, how long it's going to take me, everything I need to know along that path. So when I did that, I started to say, okay, well, the North Star starts out with what? So what is your business and what is your product? And that's description, feature, and benefit. Then the next thing is who. All right. So that's your ideal buyer profile, the ideal buyer of your business, and the ideal customer profile, the customer that you're selling the product to. And then why? Why should somebody buy your product, and why should somebody buy your company? And that's problem, solution, and impact. So now you have what your business and product is. You have who is going to buy your business and product. You have why they're going to buy your business and product. And then you need to know when. So when are you planning on selling your business? What's the time horizon? Is it a 3-year time horizon? Is it a 5-year time horizon? Is it a 10-year time horizon? And then you have to have how much. So how much money do you want to take off the table? And the reason why all this stuff is so critical is because if you raise money today and you don't know what your valuation needs to be when you exit, the starting valuation of your company is going to be too high. This happens all the time. Mm-hmm. So you start out saying, I want to have a 3 million, pre-money valuation. You raise $1 million. Now you have a post-money valuation of 4 million. Let's say you have to do 3 more rounds, very typical. And each one of those rounds grows in the valuation by not only the money you're putting in, but by the company becoming more valuable. You can quickly get to the point where the investors don't see value in your business because you're not going to give them 2 to 5x return, right? So it becomes too expensive. There's not enough profit in buying into your business. And then they can't get investors unless they do a down round, which upsets the investors they have, and everything becomes a giant shitstorm. So understanding when you're going to sell and how much you're going to sell for is critical to understanding how strategically you're going to plan out your rounds of funding and your valuation along that path. Also, if you understand why somebody is buying your business, who your customer is, and you understand who is going to buy your product, and you understand who's going to buy your business itself. So think like this. If somebody is going to buy your business, they're buying your business for a reason. Now, the best reason is because there's a strategic value. Now, what does that mean? It means that you either make or save them money. And
that's correct.
Right. And when you look at this, you sit down and you say, okay, these businesses that want to acquire other businesses have absorbed a customer acquisition cost over years, right? So they've got thousands of customers. They've already paid the CAC on those thousands of customers. And what they're looking for is another product to sell those exact customers that they've already paid for so they can monetize the value of that investment. So they can make more money on the value of the investment that they've already invested into those customers. So if you have a product and you, from the beginning, ensured that your ideal customer profile matches the ideal customer profile of the buyer, then you could say, my product, your customers will buy, and therefore you will make money on my business because you'll sell my product to your customers that you've already paid for. Now you can raise the multiple, what you're getting on either top or bottom line revenue, right? So gross profit or EBITDA, right? So it changes the whole algorithm. And this helps you accomplish the goal of time horizon, cuts down the amount of time you have because you don't need to have a ton of customers. The multiple is more valuable. So if you'd say, your top line revenue is $1 million and you get a top line multiple of 3, then your company is worth $3 million. If you get a multiple on the bottom line, EBITDA, right, then you're doing $1 million in EBITDA and you get a 10x multiple, you get $10 million. That multiple is more important than having a lower multiple and having more revenue. You understand? Because the multiple doubles on itself. So it's not like you don't have to have revenue, but if you're going to focus on a driver, revenue is way more expensive than just doing things right. So if you acquire the right customers and you go to the buyer of your business and you say, listen, I have 500 customers that are exactly the same as your 5,000 customers. And if you buy my business, each one of those 5,000 customers are going to pay you $100 or $500 a year, whatever the subscription fee is for your service. That means that your business is worth more to them than it is standalone. Therefore, it justifies an increase in the multiple. So it changes the whole dynamic, and the Northstar does that. It also changes, like, for example, let's say you raise revenue, right? So as an example, you raise, $5 million. And during that time frame, you're like, okay, I need to go to market with $5 million. So you go to market with the $5 million. And in that time frame, you burn that money getting the wrong customer. Now you try to sell your business and it's not a match and they don't want to buy your business. So essentially, all those customers that you paid that $5 million to get up in smoke. Does that make sense? So you have to start. Yeah, it does, actually. You have to start. It's like people saying, oh, I don't need to have a buyer and understand my business before I start. It's like saying, I don't have a customer in mind when I start my product. I mean, that's ridiculous, right? You have to have a customer and you have to be either saving that customer money or making that customer money, just like you do with the buyer. So the Northstar helps you identify all of these individual elements so that you can begin your journey as a startup entrepreneur heading towards what is going to be the eventuality of your business exit. Does that make sense? The liquidity event.
So it does. So 2 examples come to mind as you're talking about that. One is Yahoo's refusal to sell their business when they were hot. Mm-hmm. Right. And, there have been case studies on that. And the other example that, that comes to mind is Microsoft's acquisition of LinkedIn. Right. So let's take the successful one, right? Microsoft's acquisition of LinkedIn. Basically what they did then is that they bought into a customer base that complemented very nicely their business model as well. Would you agree?
Yeah. I mean, Microsoft buying LinkedIn was just genius, right? Because Microsoft's ideal customer profile are business people, which is the same classification of LinkedIn people, right? So Microsoft just basically, by buying LinkedIn, got this massive user base that fit their ICP, all Microsoft users, right? Yahoo not getting bought out by Microsoft was a fundamental stupid thing to do. I mean, that was just, even at the time, everybody was like, what in the hell? And the only thing I can think of is that there was something that the CEO or the board of directors had to benefit from by not taking that money, something better than the money. And because I can't understand why anybody would turn down an offer like that for that business, which is now, just
it's a shell. It's a shadow of its former self.
Yeah. It's storage of data pretty much. It's just a giant library of data. You use it for news, maybe. Maybe.
Yeah, not even.
Yeah.
It's funny. I think one of the more successful
centers of profit for Yahoo was their Yahoo Finance, but even that's been surpassed years ago by other more agile players. So
I mean, I say this a lot. The first mover advantage is not necessarily the best. A lot of times it's the second mover. I mean, look at Yahoo as an example up against Google, or Facebook up against MySpace. And you could just go around the world and look at these businesses that have been digested by other companies. The first company blazing the trail and getting knocked in the head and having to pull rocks and vines like going through a jungle with a pocket knife. And then the second mover has a trail already there, so they can just catch up to the first mover quickly and stand behind them until they have the opportunity to pass.
That's really interesting. All right, so cool. Thank you very much for that. Greg,
you're welcome.
Why don't you tell people where they can find you if they want to reach out and get to know you and your business a little bit better?
Sure. So I'm Gregory Shepard. That's my branding. People call me Greg. The website is GregoryShepard.com, GregoryShepard.com. On that website, you can learn all about Boss. I produce a lot of content to try to help entrepreneurs succeed. My goal is to help with wealth distribution by helping more entrepreneurs succeed. That's my whole vision, and the reason why I even work. So it's what gets me up in the morning, and it's what makes me happy at the end of the day. And thank you for the opportunity to be on your show.
You're very welcome. Greg, this has been an amazing opportunity, and it's been a very interesting discussion. Thank you very much for taking the time to speak with us today.
Thank you. I appreciate it. It's a great opportunity. Thank you for what you're doing.